Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, we have a huge episode for you today as we unpack everything that has happened in markets. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. I'm very excited, as I always say, but excitement isn't my overriding emotion at the moment. You know what it is?
No.
I'm feeling greedy.
Greedy.
I'm feeling like a pig in a trough because markets are down.
They are.
And it is scary, and we're going to talk about the news and everything around it today. But my overriding feeling is greed.
Nice.
Because in hindsight, all of these market downturns have looked like buying opportunities.
Yes.
And we were talking about, even before we started recording today, our big learning from previous downturns, COVID, there was a 20% fall in 2018, is that we didn't capitalize on them enough.
Yeah.
And I am not going to make that mistake this time.
Well, I want to take that chance. I was going to do it later in the episode, Ren, but the Equity Mates Facebook community has been awesome over the last couple of days. And I don't say that lightheartedly. I think the response in there, I think it's just been really nice to see how everyone has emotionally reacted to this in the Equity Mates community, which has been with calm and encouragement to each other, and also taking the opportunity to look at their portfolio. No one's selling down. Everyone's excited about the opportunity and taking this opportunity to dust off the watch list. So come and join us in the Facebook discussion group if you're not. The conversation is awesome. Keep it up.
Yeah.
Have loved engaging.
Yeah, and the link is in the show notes or the YouTube description if you want to head over and join the conversation. So 3 parts to today's episode. We're going to start with the news, what's happening with tariffs and markets. Then we're going to talk about the power of long-term investing. We're going to remind ourselves why it's important to stay invested at times like this. And then we're going to close it out by answering a community question about how we are approaching this downturn, what we're buying and what we're not selling.
News and markets.
All right, well, let's start with the news of the moment. And obviously, we're going to talk about tariffs and the market reaction, but also companies, how they're reacting and how countries have reacted. But let's start with recapping where we are. So, Bryce, what's happened since Wednesday afternoon US time last week?
So, Ren, Trump has introduced a 10% global minimum tariff aside from Mexico, Canada and Russia across the world, all countries.
And Russia, because the US doesn't trade with Russia at the moment.
Yes, complete ban. That includes uninhabited islands like Heard and McDonald Island.
Yeah, the penguins were peeking at that.
Yes. Since then, 60 countries were also hit with an additional reciprocal tariff. The formula used to determine that is hotly contested.
Yes, yeah. Trade deficit divided by total imports of goods, which is not an indication of trade barrier.
No.
It's an indication of trade deficit.
Yeah.
And, a number of countries that don't have a lot of trade barriers but have a large trade deficit with the US got hit with big tariffs. But luckily for Australia, the country that was singled out multiple times by Peter Navarro, by Donald Trump in his Rose Garden speech for having a lot of trade barriers, because we don't have a big trade deficit, we didn't get hit with anything above the 10%.
Yeah.
So the calculation is bullshit. Let's just call a spade a spade. It's not a measure of trade barriers. But that's actually worked out well for Australia.
Yeah, very well.
Like, they were calling out our PBS, they were calling out our biosecurity laws, they were calling out our media laws.
Yeah.
All that seems fine now.
Yeah, so we can just get on with life. The market reacted pretty strongly and swiftly. The S&P 500 was down 11% in 2 days, almost getting into correction territory, and the Nasdaq also got wiped. It did hit correction, which is defined as a 20% fall from its most recent high. So pretty aggressive. I think something like $6.5–7 trillion was wiped from US markets.
6.6 trillion in 2 days.
In 2 days, yes. And yeah, keeping in mind that if you zoom out a little bit, since sort of mid-Feb, the market is down sort of close to 20%, particularly the Nasdaq.
And I think the thing to keep in mind with markets reaction is there has been no winners. Like the story of the year before this was, Europe and China and Hong Kong were doing well, and the UK even was doing okay, and Australia and the US and stuff were doing poorly. But the fallout of the past week has been broad-based. No one's up. Yeah. So let's have a look at some of the individual countries' reactions, because I think ultimately what Trump wants here is to negotiate. It sounds like. I think it's worth pausing there because there are two conflicting views on what is happening, and some people are holding both in their heads, but they are mutually exclusive.
Yeah.
And we've had different Trump officials come out in the media and argue both sides, but it can't be both. Because on one side, we've had people like, I'm going to get there now, I can't remember who's on whose camp, but like people like Howard Lutnick have come out and said, we are at a point of maximum leverage.
Yeah.
And Trump is now going to negotiate better deals.
Yeah.
And then on the other camp, we have people who want manufacturing to come back to America.
Yeah.
And for those people, you can't negotiate better deals.
Yeah.
You can't have these tariffs come off. You need the tariffs to stay on to drive manufacturing back. In theory. It's not how it would work. But somehow they're holding both in their heads at the same time.
And weirdly, so is Trump. Like, he says both sides of the argument.
Yeah, I don't know if he's holding either in his head at this time.
Anyway, so China got a 34% tariff slapped on them. They have responded with a 34% tariff. Trump then came out and threatened an additional 50% tariff, which would mean a total of 104%.
Yeah, because there was a 20% earlier in his presidency as well.
Yeah. So that's where it's at with China. China have said that they have the monetary and fiscal tools available to take whatever Trump throws at them. So it's going to be very interesting to see what happens there. Should countries need to move their manufacturing elsewhere, you would think China would be a big winner in that space. The EU are preparing a reciprocal package as well, reportedly targeting the tech and services industries.
And I think this is an important one to dwell on because all of the trade deficits we've talked about, all the calculation, everything is all trade in goods.
Yeah.
But the US has massive trade surpluses when it comes to services with a lot of countries, and the EU are going to potentially cross the Rubicon in some ways. They're going to target something that no one else has really targeted so far with reciprocal tariffs, which is the flow of cross-border services. So that'll be an interesting one to watch.
And then back here in Australia, as you said, Ren, we came off pretty light compared to other countries. We are not responding at the moment. 50 countries apparently are knocking on the door to make a deal with Trump. Now, as Ren said, whether or not that's the outcome that they want, a lot of countries are knocking on the door. There's been a lot of media recently of Netanyahu from Israel being the first political leader to go to the White House to try and make a deal. A lot of people on Twitter saying, even Trump Jr. saying you don't want to be the last country to make a deal with Trump.
So Anthony Albanese, Australia's Prime Minister, confirmed they have called the US and they are one of those 50 countries that are looking to make a deal. The question is, are there deals to be made, or are they trying to encourage long-term investment decisions from companies? Which leads to how companies have reacted. So here's an estimate just to give you a sense of the scale of these tariffs. So estimates on what it will cost Apple, $40 billion a year in tariffs.
Crazy, yeah.
For context, last year Apple made $94 billion a year in profit. So, they can afford it. But if that halves their...
think about what that'll do to market cap.
If it halves their profit, it doubles their price to earnings. So let's just say that their price to earnings remains steady. It'll wipe more than $1 trillion of value off Apple's value.
It's crazy. But so the issue here is uncertainty. And so companies can't plan and invest. And we're seeing a couple of instances already. Nintendo have paused pre-orders for their Switch 2 and Jaguar Land Rover are pausing all of the imports of their British-made cars for 1 month, waiting it out to see what happens. So all of a sudden you're starting to see companies pause, slow down, not invest. It's impossible to make long-term business decisions when there's still so much uncertainty in the air.
Yeah, well, and to the question that we asked earlier, like if you were Apple or any of these companies and it was like, you need clarity on if Trump is going to negotiate before you start making these long-term investment decisions. So that's the news of the moment. We were going to do a quick recap, but there's a lot to cover. I think it's worth just framing this in its historical context, because this isn't the first time the US have tried mass tariffs.
No.
1828, they tried it.
Yeah.
1930, they tried it.
Yeah.
Spaced about 100 years apart. Some may say that's because that's sort of living memory. That's long enough for us to forget the impact of the last time we tried it, or the US tried it, because the impact of the last time it was tried both caused depressions.
Yeah, big time. So let's have a look at the Smoot-Hawley tariffs in 1930, Ren, because it's sort of, well, not reminiscent, but there are some
history doesn't repeat, but it
similarities.
rhymes. Yeah. So in the 1930s, Republicans called tariffs essential for the continued prosperity of the country. Sound familiar?
It does.
In the 1930s, Herbert Hoover, the president at the time, said an adequate tariff is the foundation of farm relief.
Yes.
Good for farmers.
Good for farmers. Well, 2025 sounds like Trump when he told the joint session of Congress, our new trade policy will also be great for the American farmer.
He then said, I love the farmer.
I love the farmer.
He actually did. That's an sign. In the 1930s, Senator Reed Smoot of Smoot-Hawley tariff fame, he called critics of his tariff internationalists.
Yes, which is eerily similar to the globalists of today.
Yes. So history may not repeat, but it certainly rhymes. Hopefully this part doesn't rhyme. The effect of the Smoot-Hawley tariffs, they didn't cause the Great Depression, but they certainly entrenched the economic harm and elongated it. But if you zoom in specifically on the impact of on trade, the tariffs and then the reciprocal tariffs by America's trading partners saw America's total trade volume fall 67% during the Great Depression.
So it's these sorts of stats that I think are worrying people without a clear idea of where this is going to land. I think we've got a lot of volatility to come.
All right, Bryce, well, we've covered off the news. I think it's now important to remind ourselves of the power of long-term investing. Why, at times like this, it pays to stay invested.
Yeah.
And I think there's 3 points we want to make here. First of all, the long-term performance of the stock market includes times like this. Secondly, is if you miss the recovery, you miss out. And then finally, picking the turnaround is near impossible. So let's start with that first point we want to emphasize. All of the long-term stock market performance, all of the history of the stock market includes times like this.
We harp on about the All Ordinaries returning 13% a year for the last 100 years with dividends reinvested. And that's not just us cherry picking the best years and saying the average has been 30%. It's every single year that is included Great Depression, World War, trade wars, you name it, COVID. That return has included the wall of worry that we often talk about.
It's included prime ministers going missing off the coast. It's included not just COVID, but like the Spanish flu. It's technological disruption.
The Bombers not winning a flag in 20 years.
Like companies collapsing, like everything that we're worried about, the market has overcome in that 124-year history that we always mention.
And I think that word there, overcome, is the most important thing that I constantly remind myself in times of this, because it always has recovered, and not only recovered, but it has always gone on to reach new highs.
And I think the stat that we were talking about earlier is if we go over to America, the S&P 500 falls 20% or more every 4 years.
Yeah, thereabouts.
I mean, if you look back on the last 7 years, this is the fourth fall in those 7 years. So that's even more frequent, 2018, 2020, 2022, and now 2025. So I think the first thing is this isn't out of the ordinary. Which leads us to the second point. What history tells us, if you miss the recovery, you miss out.
Yeah, this is also something that I remind myself, because this is what freaks me out the most. If you're trying to sell out and you miss the side on the way up, you are in a lot of trouble. A Bank of America study of the S&P 500 from 1930 to 2001 shows that there is significant impact on your total returns if you miss just the best 10 days of each of those decades.
So let's look at some example decades to give you a sense. You know, in the 1940s, you would have returned 35% if you just held. But if you'd missed the 10 best days, you would have lost 14%.
Wild.
Or in the 1990s, you would have returned 316%. But if you missed the 10 best days, you would have got 186%. So the Bank of America rolled that up and looked at from 1930 to the end of 2021. If you just held through that whole time, 17,715% return. Epic.
Wow.
If you'd missed the best 10 days of each of those decades, so what, 90 days across 9 decades, 28% return.
That is wild.
I know.
That is wild.
It is wild, and it's hard to get your head around. But
it is hard to get your head around.
It's because you get all of the worst days.
Yeah.
So you get all of the bad,
yeah.
But then you don't get that sharp recovery.
Yeah, yeah. So you almost get a double whammy in selling at a low point and missing the upside.
Yeah.
You're down on the way out, down on the way up.
But here's the thing, and here's why this is important. The very best days of the stock market often happen at the worst times. So this is research from Hartford Funds, and they looked at when those best days happen. 78% of the S&P 500's best days occur during a bear market, so after the market has already fallen more than 20%, or during the first 2 months of a bull market. So that's when the market is just starting its recovery. You know, if we look back in the GFC, the S&P 500 bottomed on the 9th of March, then all of the concern around a double dip recession and the economy going to collapse, it was up 30% by May, it was up 60% by the end of 2009. If you were waiting for that perfect moment to buy, you probably missed that sharp inflection up.
Yeah.
And I think that's really the second point that we want to emphasize, that if you miss the recovery, you miss out.
Well, Ren, just to illustrate that point, we've got a chart here that shows the various S&P 500 drawdowns and how the market reacted following the trough or the lowest point. So let's take the GFC. 2009 was the lowest point. 3 months later, the stock market was up 39%. 6 months later, 53%. 2 years later, it was back up almost 100%.
Yeah, and I think that sharp 3-month number is the one to illustrate. You know, COVID-19 in 2020, after 3 months after the trough, the market was back up 40% already. You know, you can look at the Great Depression, 3 months after the trough, the low point of the Great Depression, the market was up 93%.
Yeah.
If we go more recent, you know, the 2018 when market fell 20%, 3 months after the bottom, it was up 19%. You know, the European debt crisis at the bottom, 3 months later, the market was up 11%.
Yeah.
You don't want to miss that sharp inflection up. That's really the second point. If you miss the recovery, you miss out on like a big chunk of your returns, as that Bank of America study told us, which really leads us to our third point.
Yes.
Picking the turnaround is near impossible.
Near impossible. And Ren, that's because the perfect time never looks like the perfect time. We're not sitting here being like, we're in the trenches right now, but you know what? This is the time. This is the bottom of the market. We've taken a look at 3 of the most recent market collapses, 2001, 2008, and 2020. And we've got some newspaper headlines from the perfect time to invest, which is the bottom of the market. Because what is clear is that it wasn't easy to tell that it was the bottom of the market. So if we look at 9th of October, 2002, the NASDAQ is down 78%. This is the bottom of the market. The Wall Street Journal headline was, "Debt woes don't discriminate. Tech stocks close lower. Investors seek defensive positions." Nothing in there telling us, hey guys, this is the bottom of the market.
Yeah, if we fast forward to the GFC, 9th of March 2009 was the bottom. The S&P 500 was down more than 50%. The headlines from that day, Wall Street Journal, tech drop takes down stocks. Also the Wall Street Journal, China warns of severe fiscal conditions. And in the Financial Times, Obama urged to let the banks fail. No indication there that it was the time to get back in the market.
Yeah, well, I mean, even right now, yeah. I mean, looking at the headlines over the last couple of days, you wouldn't know. But in March, 20th of March, 2020, the S&P 500 was down 31%. It was the fastest fall in stock market history. It was the bottom of the market. The New York Times was saying a torrent of job losses threatens to overwhelm the US economy. Again, coronavirus layoff surge overwhelms unemployment officers. The Wall Street Journal, venture market shows sign of stalling, and the Financial Times, US to be swamped by jobless claims. Again, nothing in there that indicates this is the bottom of the market. It is near impossible to time the bottom of the market.
So let's put this together. You don't want to miss the recovery because they're some of the best days, and those best days can drive a lot of your total return. And picking when those best days are is almost impossible. So what's the answer for people like us who are just trying to build wealth over the long term? To our mind, there is only one answer, which is to stay invested. Because if you try and time the market and you miss out, that is going to be more detrimental to your wealth long term. The market historically has always recovered. This is, in hindsight, these moments have always looked like great buying opportunities. So stay invested, stay the course, stick to your plan. And if you have the cash on the sideline, think about buying more. And that's probably a good segue to a break. And on the other side, we're going to talk about how we're personally approaching this moment.
Financial markets around the world have taken a beating for a second day as investors fear Donald Trump's trade tariffs could trigger
The price of new cars in the U.S. will skyrocket in coming weeks, and maybe even sooner than you think.
With markets having trillions wiped and Ren sitting here feeling greedy, we have a question that is coming from Luke about how we're personally investing.
Yeah, now this wasn't a voice note, just via the contact form, but he asked, with this market crash, how are Bryce and Ren thinking about buying in? Are you adding equally to your core and to your satellite, or focusing on one? Also, I was wondering about timing. Obviously, it's going to be hard to pick the bottom, so what is your strategy for buying in? Great question, timely question, not the only question we've got along those lines. It's certainly, it's obviously front of mind for everyone how to play this moment.
Yes.
So why don't you start, Bryce? How are you playing this moment?
I have taken the opportunity to do a total portfolio review.
Okay. How far are you down?
Shitloads. Okay. Yeah. Let's just say, the leverage, I know the risk I'm taking with these leveraged ETFs. Yeah. And in moments like this, I remind myself why I should have listened to Charlie Viola when I spoke to him at the start of the year and he told me to de-risk a little bit because so much of it was concentrated around the US.
Well, yeah, a shout out to the YouTube comments who have been having some fun with your leveraged ETFs as well. Yeah.
Look, don't get me wrong. I know the risk I'm taking.
Okay, so you're doing a total portfolio review.
Yeah, because look, I look back on some of the big moments that we've spoken about, most recently 2022 and COVID, and I felt like you've said it many times this episode, we look back in hindsight and at them being great buying opportunities. And I never really went for it. I just kind of kept doing my strategy throughout that period, which is completely fine. But this time I have taken a bit more of an active, opportunistic approach. So earlier in the week, I put more money into my index funds as a starting point. Because for me, it's like I hadn't really gone through all of my stocks and really determined what I wanted to do there, but it felt like a good time with markets absolutely wiped to put money into my index funds. So that's what I did, 4 ETFs, money in. Then I'm having a look at my thematic ETFs. ATEC, the Australian technology, is looking pretty good. It's been wiped a bit, but it's full of those quality Aussie companies, not the banks, not the miners. And so I'm pretty interested in that one. And also my Fairlight position with, my small caps position with Fairlight. I'm going to have a look at that and probably put a little bit more in there. In terms of individual companies, I mean, in my portfolio, Alphabet, Eli, Berkshire, which has actually done incredibly well this year.
Yeah, because he's got 330. He timed the market perfectly.
He nailed it, yeah.
I saw some stuff today that was like, this is Buffett. He is going to prove that he is the GOAT by watching this market turn down and then deploy $300 billion in the most opportunistic moment and just set Berkshire up for the next however many.
Wild.
But just remind everyone that
it's wild.
This is why he's the best.
I saw he's like the only billionaire in the top 20 billionaires or something this year to be to have increased his net worth.
Yeah, right.
He's up 13 billion. Musk is down 160 billion. Anyway, so I've got Alphabet, Eli, Berkshire, Supermicro, and of course Bitcoin, all of which have taken a pretty decent haircut. So I'm going to review those positions. But to be honest, I'm at a point where I just need a little bit more capital. I took some money out of the offset to put into my indexes, and for me that's like I just wanted to take the opportunity to get in on those, and I'll assess the others over the coming weeks, because who knows what's going to happen from here. For me, the fact that this 20% drawdown doesn't happen too often, although we said it's been more frequent in sort of the past decade, but I took the opportunity to get in.
Nice one.
Yeah.
Eli Lilly down about 25% from its all-time high.
And I just look at that being like, so bullish. We've spoken about it on the show. Yeah. Just like long-term bullish on the trend, how they're positioning themselves, the development in drugs. Like, I haven't felt like going out and buying all these new positions. It's like, what have I got in my portfolio that I'm still super bullish on? And can I just take this opportunity to put more money in there?
Yeah. So I am similar to you in terms of how I'm thinking. I guess for me, my core strategy, I'm not going to top up my core ETFs. For me, it's like I'm going to keep dollar cost averaging into those. I get the benefits of lower prices with my regular investing. You can buy more with the same dollar amount invested. So I'm not really thinking about changing anything there. I'm just going to keep doing what I'm doing, keep it automated, keep it ticking along. I am focusing on my satellite with the money I have spare, and I'm really glad that in my automated financial structure, every time I get paid, money goes automatically transferred to different accounts. One of those is a satellite investing account, and so that just means I've got some dry powder, essentially.
Yeah.
I will not have that dry powder for long.
Yeah.
Well, I don't know. I'm not going to just spend it all this week, but like in this downturn.
Yeah.
Which is the point of having it.
Definitely.
So then the question is, all right, well, where do I want to spend it? I have this note on my phone of stocks to research, things we hear about on the show. And one section I have in there is like never cheap stocks.
Yep.
Stocks that you just hear over and over again that are like high quality, but they just always are expensive. Mm-hmm. And so you can be so convinced on the thesis around the company, but you can just never be convinced around valuation. And so for me, like that never cheap list becomes a little bit of a watch list at times like this. And to be honest, I was doing some research on them this week, and none of them are cheap at the moment.
Yeah.
Pro Medicus has a price to earnings above 100. It's like things haven't fallen that far yet. But, some of the names that I'm looking at, some of the names that are on this list in Australia, you've got the likes of Xero, Pro Medicus, Cochlear, REA Group, WiseTech, although it has got a little bit cheaper recently. Ordinate also got a little bit cheaper recently. In the US, some of the big tech names, the ones we always speak about, Eli Lilly you've spoken about, but like the Visas and the MasterCard, Axon Enterprise, a company I love, Intuitive Surgical, those Da Vinci machine robots.
Yeah.
Just love those machines. We heard about Nubank, the Brazilian fintech, on the show recently on a Pimp My Portfolio. So just companies like that are just like, that trade at crazy valuations, but are incredible companies.
Yeah.
So they're some of the ones that I'm watching. None of them really have fallen into the like pull the trigger stage yet.
Yeah.
One that I was looking at this morning is Reddit.
Yes.
It's like the 5th most visited website on the internet, but it trades at a massive discount to some of its other peers. But it doesn't monetize in the same way that some of its peer websites do. But I was having a look at it because it's down 60% since February. So it's really been whacked. And that's despite turning profitable in the last 2 quarters. It did about 71 million in profit in the most recent quarter. If you annualize that and then you look at its current valuation, it's still trading on a price to earnings of about 60.
Wow.
So again, like a lot of these stocks are like they're falling, but they're still
It's not a fire sale.
they're still not cheap.
Yeah.
And so for me, that's probably the question around where I'm looking, but also the question around timing. I'm not sure there's anything that's like a screaming buy yet. So, things keep falling. That's probably where I'll be looking. If things kind of plateau around here for a little while, I guess I'll just slowly start averaging into some stocks I already own. Maybe top up my core ETFs if nothing really stands out. But I think the takeaway is the powder that I've got dry, I'm not going to miss deploying some of it.
Chance, yeah. I would say if you're looking at individual stocks, be cautious about the impact on tariffs. Because
yes.
Yeah, well, I mean, like if you're just sort of willy-nilly throwing money around just because things have gone down, that's obviously not the way to do it. But particularly with individual stocks and a lot of uncertainty at the moment, definitely do some research on the impact of tariffs. I just want to give a shout out to the Facebook group again, Ren. There was a post in there yesterday. Since everything is on sale, what are you buying? Many comments coming through, but it's good to see a lot of the community. Obviously, right up the top, a lot of the favourites, DHHF, VAS, IVV, NDQ, a lot of people looking at Macquarie, everything that we've sort of spoken a lot about on the show, that long-term, low cost, people are taking the opportunity. So love to see it.
Love it. Well, let us know what you're looking at in the YouTube comments, in the Spotify comments now. You can do comments there. Or hit us up, equitymates.com/contact. Would love it if you left a voice note with what you're buying or just any questions that you have. And we're going to be on top of this story for as long as it lasts. So make sure you're subscribed wherever you're watching or listening to keep up to date with what's going on and how we are approaching it. But Bryce, that'll do us for today.
Love it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.